We're going to get a technical assessment of the U.S. equity markets, and if you're long stocks, you're going to like what our next guest has to say. Joining us from New York is J.C. Parets, president and founder of Eagle Bay Capital. He's also editor of the technical analysis blog, allstarcharts.com. J.C., let's start with the bigger picture. You see an expanding base forming on the broader averages, and I love this, on the back of a beautiful consolidation. Tell us what that means in layman's language.
Yeah, I mean, when I look at all the major, U.S. stock market averages when it comes to the large caps, the small caps, I mean, it's hard to be bearish. I mean, we could start with the small caps and the mid caps. Look at the Russell 2000, look at the mid cap 400. Year-long consolidation since early last year when they originally peaked. Remember last year, the big winners were the large caps. The small caps and mid caps and micro caps didn't do much. They're now coming out of these big bases. It's hard to be bearish in front of that. And then you look at the large caps which outperformed last year. Look at the Nasdaq 100, S&P 500, Dow Industrials, transports. I mean, since the highs in November and December, they've been consolidating in a very nice range, and now we're breaking to the upside. We recently just saw that in the Nasdaq 100. I think transports are next, and like I said, it's a rising tide lifting all boats.
Just on the transports, because they've been a bit choppier here, they haven't broken out yet, but you think they will?
I do. The rest of them have in terms of the large cap space. I think transports are next. I think we probably see around 47.60 to the upside. That's the measured move. For traders, short-term guys out there and gals, we really only want to be long above this breakout that I think is coming, and I think that should take us to about 47.60. That's the target.
You sent me an email just a little bit ago, and we had a lot of things that we were going to talk about, but you did mention natural gas. We're freezing up here. I think you're freezing in New York, but natural gas hasn't really played the game it usually would. I always say traders look outside and they buy gas if it's cold. But what is your take on natural gas right here?
Yeah, I mean, listen, there's a lot going on. I mean, first of all, natural gas prices essentially got cut in half in 2 months. They went from, the high fours to 2.5 or whatever the case may be. I mean, really got slaughtered. You don't hear a lot of people talking about it. We do a lot of sentiment analysis, Francis, as you know, and, natural gas is a space that we're hitting extreme bearish sentiment that we haven't seen in over 5 years. I mean, we're at extreme bearish levels. Meanwhile, we like to see what the smart money's doing. The commercial hedgers are, we're seeing net long positions nearing historic records. So the smart money loves it, thinks we go a lot higher. Then we turn to seasonality. This time of year, what does natural gas tend to do? Well, in the winter, historically, is the worst time of the year for natural gas prices. We're coming to an end of the worst seasonal period in natural gas. So the spring traditionally is a very bullish time for nat gas prices, so I love that. So all that is great, but let's turn to price and risk management, which at the end of the day is the most important thing. Like I said, prices got cut in half in 2 months, made new lows in January. But then a funny thing happened. In February, we made fresh lows this month. But meanwhile, momentum was simultaneously putting in a higher low. That's what we call a bullish divergence. We love to see that. So from a risk management standpoint, we only want to be long natural gas above the January lows. If we're below that, all bets are off. So the risk is very well defined, which we love. And I think the upside could be tremendous here. I think we could see close to $4 again.
So would you start putting a position on with that? The January low was, I don't know, 270-ish. The February low, 250-ish. So would you put some stops in there, but also start building a position?
Yep. Well, I'm in. We're in. We're in pretty heavy. Again, risk management wise, it's very well defined. We only want to be long above the January lows. Below that, all bets are off.
Okay, well, that is pretty clear. Let's move to something else as well, which is the internet space. I know you like healthcare, but I think the internet space might be interesting as well. A bunch of the names that you're looking at, and Twitter shows up there. And Twitter intrigues me. Tell me about Twitter and that whole social media space.
Right. So, as I've been pounding the table to get long internet stocks, specifically the Dow Jones Internet Index, which has really exploded this month. We absolutely love it. We're back to last year's highs. I think we go higher. We're probably heading towards the mid to high 70s in FDN is actually the ETF that tracks the Dow Jones Internet Index. That consists of companies like Amazon and Google and eBay and Netflix, CRM, things like that. But I want to turn our attention, that already broke out. We nailed that. I want to turn our attention to a little bit more specific area in terms of social media. The social media ETF, SOCL, which is a Globex fund, and that consists more of, Twitter, like you said, Facebook, obviously, LinkedIn, a basket of the Chinese social media stocks as well. So I think that one is ready to explode also. I love the fact that prices are below an upward sloping 200-day moving average. That's, those are tough to find out there, but I love it. I think we get long above the 200-day. I think it follows the internet group. Overall, I think this is the next one to go for sure. I think we probably head back to 23 where we were last year.
That is terrific. JC Parets joining us from New York, allstarcharts.com. Thanks for taking the time this morning. Great ideas.
Thanks for having me always, Francis.
We'll see you soon.